Focus. Ideate. Innovate. Enable.
United Way of Chennai, part of the global charity organization United Way, is back with its annual fair of post-budget discussions. Looking at the current scenario, United Way of Chennai zeroed in on investing in volatile times as its theme this year.
United Way of Chennai, a charitable organization, is focused on helping people in and around Chennai in areas of education and healthcare, primarily focused on doubly disadvantaged people who are economically weak and do not have the support. The budget session that we organize every year is a very well attended session, serves as the largest fundraiser for United Way of Chennai, where financial institutions contribute substantially to the causes that United Way of Chennai is supporting. We are so thankful to all the HNIs and the financial institutions for participating in the post-budget session.
The theme, investing in volatile times, seems to have struck the right chord as the turnout was impressive, and that too, it was an eclectic mix of audiences. Financial experts, corporate chieftains, stock market gurus, economists, bankers and NGOs. This annual post-budget session is United Way of Chennai's flagship event. Renowned economist Partharthi Shom, in his keynote address, not only decoded Budget 2016 but also raised some serious concerns.
I want to talk about the budget itself and the kind of numbers that don't seem to match quite. Right at the beginning, the finance minister said that we have reached now 7.5% real rate of growth. But as you will recall, in the last quarter ending December, our industrial index was close to zero. Export growth in some sectors was negative. On the whole, again, it was next to zero. So I was wondering, with one quarter going like that, how will the numbers turn out to be all that, high? So when he started with that, I gave keener attention to what he was saying, and it seems to me that step by step, I was getting a little convinced that the numbers don't seem to be quite matching what's happening in this exercise. Starting from the banking sector, I look at the recapitalization point, and there was not much that he had said there either, whereas we know, for good or for bad, even though it really reveals the kind of inefficiency of the sector, but especially the public sector banks, they are also pressured in many ways. When I look at very quickly at tax policy, after this touch on the monetary sector, again, the promise that was made last year that 1% reduction per year in the corporate tax, that was completely moved away from. So the mention was made to accommodate what was said. Indirect taxes, I found, were unnecessarily tinkered with in the customs duties, when in the earlier stages we were bringing down everything in a streamlined manner to reduce the number. Now we have more differentiation, together with more complex VAT rules and more and more complexity, and no word about GST. But anyway, I must also confess that the current proposals, despite the great euphoria about GST, the current proposals on the structure of GST are so distortionary that I really wonder when it comes into being whether it will be administratively better for the taxpayer, especially the medium taxpayer. So perhaps if it is postponed, it will be looked at a little bit more, but I don't think it will. So on the whole, I think that the tax policy structure was made more distortive, which I had not expected. The result is that to get the government maintain the trajectory of fiscal deficit and the 3.5%, so the whole tax advisory profession were very happy about it. But if you really look at how this will be maintained and how the fiscal gap will be filled, then you get to realize how poor that plan is. So 45% of non-tax revenue is allocated from RBI and dividends. Then comes disinvestment, which is somewhat around 10% plus. It is budgeted at 56,000 crore. Now, disinvestment in no year has been that high. The last one is the telecom services, which is also very, very high. To sum up, first, I would say the budget has placed little emphasis on a robust tax policy or tax revenue sources of financing. So the second conclusion I would say is that there's a too heavy an emphasis on non-tax revenue, and even at a first glance which I've given, these are unlikely to happen, reflecting both these non-tax revenues' historical trends as well as their present condition, like the state of health or the state of litigation that they are suffering. So the likelihood of this fiscal gap remaining is very, very high, and I wish the staff working on all of this very, very well. I hope somehow a miracle will occur. But the million-dollar question that I ended up with was, why did the government not make a sincere effort at comprehensive reform? Because I think that the country was with it. So it's a mystery to me as to where the slip was between the cup and the lip. I wish I could have ended in a more optimistic note, but this is the result of being honest and sometimes being rather unpopular for my views and positions in public. Thank you very much for your patience.
But the highlight of the day was an engaging panel discussion moderated by CNBC TV18's A.B. Ravi with India's top-notch fund managers S. Narain, Navneet Munot and Anil Shah. These accomplished investment experts not only guided the eager audience as to where to invest during turbulent times, but also gave them some useful investment tips.
Welcome to this special discussion post-budget. It is day 5 since the budget has been presented, and a lot has been said on TV, newspaper and internet, as Dr. Shom rightly said. So I think we'll restrict our discussion largely on investment or investors related. The topic of the discussion is investing in turbulent times. Well, I thought investing in turbulent times is not for weak-hearted. It is for the likes of contrarian investor like Warren Buffett, who is deep pocket. But we have 3 champions here on the dais who will help us to navigate ordinary mortals like us to take informed decision. If these 3 people gang up together, they can change the complexion of the market. Yes, between them they manage $57 billion, and that's a lot. Before the pre-budget, we saw the market was down by nearly 5 to 6%. On the budget day, it swung 850 points. And last 3-4 days, it is 1,600 points. So my question to all the panelists here is, should the investors read too much into this annual tamasha called budget, or they should take decisions based on other things?
I think the budget is certainly one of the important, you have in some other countries, State of the Union address or things like that. In India, budget has always been one of the important days. The importance of the budget in 90s, you had high taxation, high customs duty, high excise duty. So the process by which taxes were coming down was made budgets very fascinating, because every year you had a drop in customs duty, excise duty, income tax. Now that phase is over, and a lot of our expenditure today goes into fixed areas like salaries and interest. So there is not much cushion available with the government to actually give you incentives, because if they give you a lot of incentives, the fiscal deficit will rise, then everyone will be worried about fiscal deficit and other things. So I think the budget is an important document, but what Indians want is lot of incentives, but at the same time they want a much lower fiscal and revenue deficit. It is practically not possible for any finance minister to do that. That part people haven't realized.
So, Mr. Munot, budget is an important document, but do fund manager and investors take this decision based on budget?
So Narayan said that unlike most of the other countries where this is just a statement of government's revenues and expenditure, in India it is also a platform to outline not only your economic agenda but political agenda, and you get some cues in terms of the government policy. Also, government is a very large player, so I mean the total amount of spending that is done, and particularly let's say the cycle in which we are in today, where the government spending is very critical to revive the whole investment cycle. And still, I think whatever changes that we make in terms of taxation and all have some bearing on several businesses. And I think that the markets needs to be aware of that. Having said that, do we make significant changes in the portfolio pre or post budget? Not necessarily, unless that, let's say, a fortune of a sector has got changed so much, which doesn't normally happen.
Okay, Mr. Shah. Quick comment.
No, I think, see, over the years, clearly, I think budgets gradually but surely losing a bit of its significance, because there's so much more in terms of capital investments and so much more funds with the states. So the states now are becoming far much more powerful and far much more critical as far as the economy is concerned, not taking anything away from the center. But I think over the years, clearly the budget document is gradually but surely losing its significance. Okay. The only thing from an investment point of view, as both my contemporaries have kind of mentioned, you just need to make sure that, is there been a large accident in terms of, something which has come out of the blue, which you hadn't seen through, which is going to significantly change a particular sector's way of doing business and hence the earnings. But otherwise, normally it has a shelf life of 48 to 72 hours as far as the market's concerned.
Okay. Mr. Munot, let me get you in again here. Looking at the market volatility now, what would you say the market, in market parlance is? Is it a bull phase or a bear phase? What is it? How do you, for the people out here?
So I think we are in a structural bull phase, and why I'm saying is that I think the cyclical recovery has just started. I think that over the next couple of years, as the investment cycle picks up, there are all the signs that consumption, at least the urban consumption, there are several signs urban consumption has been doing well. With this spending and the other measures taken, rural consumption is likely to pick up well. And I think the exports have been down almost 18% YOY because the global environment has been very challenging. But as and when I think we see some recovery in the global market, over the next couple of years, I think the economy looks good. Corporate profitability is at a multi-year low in terms of, let's say, margins, in terms of ROE, in terms of the overall earnings growth. I think from here on, as the economy picks up, I think that there's going to be a good cycle of corporate profitability growth.
So which what are the terminology you will use? Are we entering the bull phase? Are we in the bull?
I think so. So we have seen a correction of more than 15% over the last 1 year. But I think from here on, market looks like very close to the bottom, and we can expect a good uptrend over extending over the next couple of years.
So Naren, what phase would you say the market is in?
See, I think from an economic cycle point of view, the year where all the bad news comes out, both globally and locally, is obviously a good year to invest. I mean, the environment this year is a good environment for long-term investing. And clearly, if you look at a cycle, the cycle has to improve. Today, capacity utilizations are low. If you look at anyone, everyone is scribbling about X or Y or Z. You have an economic situation which doesn't look good. So I think at this point of time when growth is low as what we perceive, I think is always a good time to invest in equity. The time to sell out of equity is when everything looks good. And today we are in that situation where things are not looking that good, particularly globally. Okay. And therefore there's an opportunity.
Mr. Shah, when I look at the FIs, they have been net sellers this year. They must have invested something like $32 billion till date. But this calendar, there's something like $2.6 billion are net sellers. So are they selling emerging market or are they selling India? Because everybody's saying India is a good story. What are FIs seeing that we are not seeing?
At the outset, I think, we all need to understand that we are a part of a bigger world out there, and particularly a bigger world called emerging markets. And, this word in terms of emerging markets became extremely popular way back from 2004, 5, 6 onwards, and particularly all the way till 2011, 12. It's only now that it's dawning on the investors that each emerging market is actually pretty different in terms of its dynamics, in terms of its variables, in terms of the way they function. So what could be good for India today, which is oil prices down, is not necessarily good for Russia, because they are pretty much dependent on oil and gas. And at the end of the day, they've kind of realized that just putting money in emerging markets hasn't really worked. So they've lost some significant amount of money, both in equities and in currencies over the last 1 year, 3 years, and 5 years. And we are a small part of the emerging markets, and they're seeing some serious redemptions because of these losses. Within the emerging markets, without a doubt, India stands out. Our macro is in shape. We are one of the few countries in the world where we are seeing declining interest rates, inflation relatively under control. We are one of the few markets, again in emerging markets, which is seeing a relatively more steadier currency over the last 2 to 2.5 years, barring the first few months. And we are finally a country where, there's genuine hope of reforms. However, having said all this, being a part of the emerging markets, there were huge redemptions. They were selling most of the emerging markets. India was a part of this.
Okay.
I think there will be a time where country funds will again come back in focus. And at that
that's what I
point of
want to
time,
know. What will take them to come back, Mr. Munot?
So I think, as someone rightly said, that India is a nice house, but in a bad street. Because the whole street is not liked by the investors. They are selling everything, and we are not able to market our house properly. But I think we have seen that throughout in 2014 and a good part of 2015, where the same FIs were selling other emerging markets, but India was doing well. Flows were positive. They could differentiate. But now the overall outflows from the emerging market equity funds, the sheer magnitude has ensured that we are also getting redemption. At some point in time, in last 3 or 4 days, the foreign investors are particularly very enthused after the budget in terms of the overall macro stability, the promise that has come because of the fiscal deficit and the other reform measures. I think if the global situation improves, and my call is that I think the commodity prices are likely to stabilize, and the overall emerging market as an asset class has really touched a bottom. The currencies have got butchered. The stock markets have fallen quite a bit. Overall emerging markets as an asset class is likely to become a good value at these levels. Redemptions are likely to stop or maybe recede, and then we won't have as much outflows from the foreign investors. Globally still, I mean, whichever part you go with, to whosoever investor that you talk to, they still like India a lot.
What would their advice to the investor be, all three of you? Starting with Naren.
I think 2 years back in a United Way budget event, I got a chance to present. So in that event also I said the biggest way in which investors can benefit out of volatility is by practicing asset allocation and or investing in hybrid asset allocation kind of products. The big challenge is people want to invest in the asset classes which have done best in the last 1 year. That is exactly the opposite of asset allocation, and that's exactly the way to lose money. So as I pointed out then and again, is that if you practice asset allocation, you're through. But remember what asset allocation is. Asset allocation is investing in an asset class which has done very badly and cheap, and investing in asset class and taking out money from asset classes which have done very well. So in 2015, after 1 year of equity doing well, you have to, asset allocation would have prescribed taking out money from equity and putting it in debt. It would have been very difficult last year. This year, for people to take out money from debt or liquid funds and put it in equity is not easy, but clearly that's what asset allocation should do. So I think it's simple. Practice asset allocation, you have made money in volatile markets.
Mr. Manoj?
So it's simple, as you rightly said, that I think asset allocation, depending on everybody's risk expectations, the risk appetite, your liquidity needs, time horizon, based on all these factors, you decide the asset allocation that you need to have, and then stay disciplined. I mean, then remain disciplined to to ensure that at all points in time your portfolio is balanced. So as if the markets have, a particular market has gone up substantially and your asset allocation will tilt in a different flavor, then you need to rebalance it a little bit. But over a period of time, the systematic way of investing, and I think over a longer period, we have seen in last whatever 10, 15, 20, 30 years, equity markets have delivered better returns far above inflation rate. And I think that discipline is very, very important, having that long-term orientation and then remaining true to your asset allocation.
Okay, Mr. Shah, final question. Where to invest today or tomorrow? Which, if you look at short term, next 12 months, 14 months, which are the sectors they should look at?
I think, honestly, I wouldn't look at equity purely from a 1 year. That's not the way to look at equity. I'm sure equity on a 1 year will do well. Asset allocation is a way to go forward. Equity from a 2 year, 3, 5, and 7 years on will do phenomenal well. A 1 year time frame where you have so much of volatile, so much of monsoons could be something that one doesn't know of, so on and so forth, can change the returns pretty much dramatically. But having said that, valuations today in our favor. Markets have corrected. Interest rates clearly some more way to go downwards. Without a doubt, expectations across generally running a bit low on emerging markets. Outflows seem to have stopped, at least in the last week's data that I saw. Almost after 16 weeks of outflows last week, emerging markets have finally seen some inflows coming back. So I think, net equity should continue to do pretty well.
Gentlemen, thanks a lot for being on the show.